if you look at this chart, there's fair value gaps everywhere. Fair value gap right here, fair value gap right here, fair value gap right here, as well as right here. But as a beginner or struggling trader, you may be in a position to where you don't know if price is going to respect the fair value gap in this case, versus in this case, when price comes into a fair value gap, it completely breaks through it. And this is what this video is going to help you fix. I've taken thousands upon thousands of trades when it comes to fair value gaps, as well as I spent hundreds of hours, if not well over 1,000 hours, when it comes to learning, backtesting, as well as journaling fair value gaps. And in this video, I'm gonna break down everything that I know to help you become a much more consistent trader. Throughout this video, I'm gonna give you guys well over 5 tips that I've learned taking thousands of trades when it comes to fair value gaps. So hopefully you guys can learn from this video and take the knowledge and apply it. And if you're new to my channel, I'm Arkham, been trading for a little over 3 years now, and within my first year, I became a consistently profitable trader and now a full-time trader. This YouTube channel is to give you guys straight trained education to help you guys become a much more consistently profitable trader and hopefully achieve some more results. If you guys get value from this video and want to live trade with me every single morning, you guys can click the first in the description. As well as I am a trading coach, so if you're a beginner or struggling trader and want me to help you to reaching your first payout or making your first $10,000, you guys can click the second link in the description and book a free call to talk to me, and I'll see how I can help you. When it comes to fair value gaps, we want to pay attention to these 2 specific things. So what I'm talking about is the classification of fair value gaps. So there's 2 specific fair value gap setups that you can realistically trade throughout the market. The first setup that we're going to be looking at is a reversal fair value gap, where price establishes a specific level to go from one direction to another, basically going from lower to now higher prices. And we can utilize usually the first or second fair value gap as a frame of entry for that reversal. And I'm gonna break it down very easily right here. So how you would frame a reversal inside the marketplace is based upon these 2 things. See here in this case scenario where price came lower to take out this original low right there. Then following taking out this original low, we can see a sharp rejection from it. From this sharp rejection, this is what we classify as a liquidity sweep. Price takes out an area of liquidity identified by this original low, and then after taking out that liquidity, it immediately runs away from it. So from that liquidity sweep, we can see here that price takes out this original high. We'll mark this as a break of structure. This liquidity sweep to this break of structure, this gives me the idea that once price took out this area of liquidity, it can no longer continue going lower. Price tends to not come back within this level. So if we can take note of any fair value gaps within this specific range, this would be classified as a reversal fair value gap, which we can obviously take note of right here. The separation between this first candle's high as well as this third candle's low right here creates a difference within the markets, notified as a gap. This gap here is an inefficiency, and usually when price creates these gaps within the markets, price tends to come back down into them before continuing even higher. And when it comes to fair value gaps, I'm gonna give you guys a tip that no one really talks about, and this is splitting them into quadrants. So if we anchor from the low here to this high, we can get our different quadrants. So a fair value gap has 3 quadrants. We have the 25%, the 50%, and the 75%. And when it comes to trading fair value gaps, you typically want to take your trade within the 25%. The reason why I say the 25% is because this gives you the best chance of price actually tagging into your entry, as well as it gives you a great opportunity to get in on a sniper setup with a good R multiple. The problem why I don't take it at the 50% is because sometimes price will come down into the 50% and then sometimes it won't. Even though you would have a great R multiple if you took at the 50%, the probabilities of price tapping into your entry is a lot less, but price has a more than often likelihood of tapping into that 25% rather than the 50%. And the difference between the 25% to 50% is not really a lot. So I would rather get into a trade with a good R multiple rather than prioritizing a sniper setup with the chance of price not actually tagging in. So whenever you're taking fair value gap trades, try to take them around the 25% for the highest likelihood. And when it comes to fair value gaps, if you want to prioritize a safe stop loss, you always want to put it below the low of that first candle. So obviously this is a 3 candlestick formation from this first candle, second and third candle. So the low of that first candle is where you typically want to put your stop loss to make sure that price doesn't stop you out. And obviously we can reach back above these high points, yielding us at least a 2-to-1 R. So you can see price comes down into that fair value gap right there. at that 25% perfectly before reaching back above higher prices. This is why I tell you guys not to really put it at the 50%, because you guys can see exactly like that. Price didn't even tap into the 50%. Instead, it came down into 25% perfectly before reaching back above higher prices. As well as in this case scenario, how I trade personally is I scale in. This case scenario, once I see price finds respect at this level, I would scale into this position right here. When price pushes back above this prior candlestick high, I would frame my long setup and I would adjust my stop loss now back below this low level right here. The reason why I put my stop loss back below this low level is pretty simple. When price creates a fair value gap and it taps into it to find support to push higher, price tends to not come back within that level. So in this case scenario, when you have your first entry, you want to have a wider stop loss to take into case any situations to where price may come all the way down here or maybe even right here, you'd be safe. But once you see price run away from it and find support within that specific level, then you can add to that position and you can trail your stop loss. And what happens when you add to that position and trail your stop loss? Trail that stop loss, you end up risking the exact same amount or sometimes an additional $100 or $200 more. But when it comes to your take profit, you end up making a lot more. So if my stop loss down here was $500 and I scaled in and trailed it right here, then my new stop loss would be $600. Yet if I was aiming for $1,000 right here, since I scaled into my position, I went from $1,000 to now $1,500. I end up risking a little bit more or sometimes no risk at all depending on where I trail my stop loss, but I make an additional anywhere from $400 to upwards of $1,000 on that setup. And this is my risk management strategy that I use on a consistent day-by-day basis that keeps my risk minimal as well as very tight, yet I'm able to maximize my rewards consistently. So this was a great example when it comes to showcasing you guys a reversal fair value gap. Now we're going to show you guys the second fair value gap. In this next example, we're going to be talking about the continuation fair value gaps. And in this example, we have multiple fair value gaps. We have this first one, obviously we have the second one right here, and we have this third one, and then last but not least, we have this fair value gap all the way up here as a fourth one. You may be in a position to where you don't know if price is going to come into the first, second, third, or fourth fair value gap, and this is how you fix it. When it comes to first fair value gap, price usually breaks through it, so I don't even look at this. Leaves us with these three remaining fair value gaps. So we have the second one, the third one, and the fourth one right here. When it comes to the last fair value gap, we want to identify our 50%. This tends to not come down into the 50% of the last fair value gap, so we want to take note of that. This really leaves you with this first one right here as well as the second one. When it comes to the second fair value gap, it's 50-50, and like I mentioned, when it comes to fair value gaps, you always want to prioritize entry, because one of the worst pains in trading is having a limit order here and price miss your limit order to go in your favor. So we want to prioritize actually getting into the trade instead of trying to be perfect. In this case scenario, we want to place our entry within the 25% of the second fair value gap right here. Put our stop loss back below the 50% here of that last fair value gap. And this is the perfect trade setup because this attacks all fronts. Just in case price comes all the way back down here, you have a safe stop loss, as well as just in case price does not get into the second fair value gap, you have a guaranteed entry right here. Well, as you already know that price is going to break through this first one, so you don't even take note of it. So in this case scenario, not only do you guarantee a safe stop loss, but you also guarantee an entry. And this is really the only way that you can trade this, because there is no specific way on how to predict fair value gaps. I've taken thousands of fair value gap trades. You can't necessarily predict, oh, maybe this specific pattern will tell you if it's going to come into the second or the third one or the first one. There's no specific way on how to predict it. This is the best way to attack all fronts, so you can guarantee an entry as well as having a solid risk management system that no one really teaches. And when it comes to continuation fair value gaps, these are usually scout moves, meaning I'm not usually aiming for a 2-to-1R or even a 3-to-1R or 4-to-1R compared to how I would be aiming for a 3 or even a 4R when it comes to a reversal fair value gap. A continuation fair value gap is towards the end of a trading range. Let's say this is the low of where the move starts. Let's say the move ends right here. If you get in on a reversal fair value gap at these lows, this gives you the best opportunity to scale in, so once price comes up here, you can maximize your reward. You're taking a fair value gap trade right here in a situation to where you're catching what's called the low hanging fruit. Basically, you're at the tail end of that entire leg from the low to the high. So you don't want to be a position to where you're aiming for a 3-to-1 R when you're towards the end of the leg, because it's obviously just going to reverse on you. So instead, you aim for a modest 1-to-1 R to a 1.5 R. In this case scenario, I'm gonna get a 1.5 R. So let's see how this plays out. We can see here price comes down into that 25% before reaching back above those higher prices. I told you guys about those 25% perfectly before reaching back above these higher prices. I hope you guys are taking notes, because this is very valuable lessons on algorithmic theory and fair value gaps that you're likely not going to find anywhere else. So if you guys are getting value, it only takes 1 second to click that like button and support the video. Now I'm going to show you guys how you can utilize fair value gaps to create a daily bias. The New York session is just about to open up. Yellow here is represented as London session, and obviously this gray box is represented as the Asia session. So an hour or 30 minutes before the New York session opens up, you want to create your day bias, basically creating an idea for whether you're going to be bullish or bearish on the day. And usually when creating a day bias, you want to create it from a higher time frame. So I'm looking at the 1 hour time frame here, and on this 1 hour time frame, I'm simply marking out my overall structure. Price likely to go higher, or is it likely to go lower, based upon where have we been, where are we currently at, and where do we anticipate price to go next. Where have we been? We can see here that price came higher to take out these previous daily highs right there, right? This is the daily candlestick right here, being a long wick rejection here on the daily. Right now, we can see that we're currently at this bullish fair value gap right here. This is supposed to be a level of support, right? A lot of people will tell you if the trend is higher and a fair value gap is right there, you should follow the trend. This is not bad advice, but it's not necessarily practical in all scenarios. Scenarios specifically, we want to pay attention to what happened before price taps into this fair value gap. Price takes out this area of liquidity. Usually when price takes out an area of liquidity and there's a fair value gap right here, price tends to break through that fair value gap. When price takes out an area of liquidity prior to tapping into a fair value gap, you don't want to set a limit order in the fair value gap. You want to see price come down into that level, and you want to see how does it react. The moment that price takes out that area of liquidity and it comes into that fair value gap, it's a lower probability, because price after taking out the liquidity pool could now be in a reversal. When price is in reversal, it's no longer respecting bullish fair value gaps, but now it's going to disrespect them. So in this case scenario, price was finding support inside fair value gaps when it was pushing higher, but the moment that it took out an area of liquidity and started seeing this break lower, this could give us the idea that it may no longer start finding support. So never put in a meet limit order inside of a fair value gap. Instead, you want to see price come down into them and seeing how does they react. And I can mark out this original low right here as a potential area of liquidity, as well as this low right here from the previous daily low. So my overall emphasis coming into the day here when it comes to creating a day bias is if the market opens up and we break through this bullish fair value gap, that gives me the idea that price is disrespecting this support level and it could potentially retest it as a resistance level, then see a reversal targeting back below these lows. This is what we then call a if then scenario. If it breaks this level and find resistance, we can take a short to go lower. If price finds support here and let's say it breaks above here, then we want to see a pullback, find support to continue going higher. So when it comes to creating a day bias, it's not always predicting the markets, it's simply creating multiple options for what could potentially happen. If it breaks to this level, then obviously it would give us the idea price is bearish. If it finds support here, it would give us the option that price is bullish. We just want to create two scenarios for what could potentially happen within the markets. So now we're going to go down to a 15 minutes time frame as the New York session is about to open up. We can take note of that 1 hour bullish fair value gap, see how 7 a.m. opens up. You can see here price initially finds a level of support, sees a push to the upside, then we can see price eventually reaches back below lower prices. In this case scenario, you may be in a position to where you may have seen multiple wick rejections at these lows and falling price higher, and you may have taken a buy position and it found support here to push higher, and most likely price would have reversed on you. And here's how to prevent that. When it comes to market structure, you have to understand that price is not yet at a reversal until it sees a break. So we can take note of this original high. Is the last swing high here before creating the swing low. The swing low because this middle candle is lower than the candle to its left and the candle to its right. Is the last candle right here that had a swing high, where the middle candle is higher than the one to its left as well as the one to its right. Till price breaks above this specific level, price is not bullish. Even though yes, it finds support to go higher, it was simply going higher to come back into this last up close candle, which is this bearish order block. A lot of situations you may see that price has found support and you may take a long only for it to reverse on you. But if you pay attention to market structure, since this is the last swing high within the markets, unless price were to break above this level, then we can take a retest to find support to push higher. As long as price is below this specific level, which this is a resistance level right here, case scenario, even though it was pushing higher, would still be patient and wait. As you can see here, price gives that rejection, and then it rejects again, basically indicating that it can no longer continue going higher or breaking back below this swing low. Below that 1 hour bullish fair value gap gives us that confirmation that this bullish fair value gap is not going to work, and most likely price is in a reversal. What we can do here is this 1 hour fair value gap, split it up into quadrants. We can get the 25% there as our inversion fair value gap. So once price breaks back below this bullish fair value gap, should now inverse it to now go lower. And our entry between the 25% of this inversion, once just back above that, high of that fair value gap right there, you can reach back below these lower prices here of these most recent lows for about a 1-to-1. You can see here, price comes back into that inversion right there, 25%, and then we can see it reaches back below those lows. As well as if you're someone who does have multiple take profits, then you could obviously have a take profit 2 down here, back below this low right here, back below this prior New York session low. Let's see if it will get down there. And eventually price does get back down into that prior New York session low right there. This would have been the setup right here. In this video, we covered a lot of things. We covered reversal fair value gaps, continuation fair value gaps, specific quadrants, how to classify different fair value gaps, how to classify between trading this fair value gap versus that fair value gap, as well as we went over proper risk management and trade management when it comes to trading fair value gaps, and then last but not least, creating a daily bias around fair value gaps to help you become a much more consistent profitable trader. As well as if you guys want one-on-one coaching where I help you personally to reaching your first payout or making your first $10,000 trading, I am opening up a few slots for this YouTube video, so you guys can click that second link in the description and apply to work with me. Or if you just want to live trade with me every single morning and catch trades just like these on a consistent day-by-day basis and don't really want the one-on-one help, then you guys can just click that first description and trade live with me and my brother every morning. You guys click like subscribe button, comment what you guys want to see next, and if you guys want to watch another video breaking down a specific trade that I took the other day that made me well over $1,200, it's going to appear on the screen right now. So make sure you guys check out that video. I'm Arkham. Be safe.